You think a holding company is a billionaire thing. Something for people with private islands and a Cayman mailbox and a lawyer on retainer who answers on the first ring. You think it kicks in somewhere past your wildest number, some level you'll unlock in a decade if you're lucky. You're wrong. It kicks in at $1 million. Not net worth. Cash flow. And most founders don't even see the wall until they've already hit it face first. This is the leveling system nobody hands you on day one. Every dollar threshold in business is a tier, and every tier unlocks a new boss fight you didn't know existed. Level 1 is where almost everyone starts, and level 1 is where almost everyone almost gets destroyed. Not by taxes, not by competitors, by their own paperwork. Your name is Marcus Elaine, and 18 months ago you were running your marketing agency out of a single LLC you formed on LegalZoom for $79 on a Tuesday night between client calls. One entity, one bank account, one EIN. Client payments come in, your salary goes out, the laptop you bought for the business and the laptop your kid uses for homework are both expensed to the same card because why would you separate them? It's all just money, it's all just you. This is level 1, sole proprietor energy wearing an LLC costume. And for a while, it works. It works right up until it doesn't. Here's what nobody explains to you at $80,000 in annual revenue. An LLC is a liability shield, but only if you actually treat it like one. Commingle your personal and business funds, and a judge can pierce that shield like it's wet cardboard. Lawyers call it piercing the corporate veil. What that actually means in plain terms is this. The wall you thought was protecting your house, your car, your kid's college fund was never really there. It was a formality you filed once, and then ignored for 3 years while you paid your mortgage from the same account that pays your subcontractors. You don't feel any of this at $80,000 a year. You barely feel it at $300,000. The chaos is invisible because the stakes are still small enough that nobody's coming to collect. That's the trap. Level 1 doesn't punish you for the mistake. It punishes you for the mistake 3 levels later, once there's actually something worth taking. The moment it stops being theoretical is the moment your agency crosses roughly $1 million in cash flow. Marcus hits it in March. New client, a regional healthcare network, 6-figure retainer, and suddenly the business bank account has real weight in it for the first time. And that's exactly when a freelance contractor he'd let go 8 months earlier files a claim. Breach of contract, unpaid equity promise, the kind of dispute that used to be a bad email exchange and is now a lawsuit with a docket number. Marcus calls a lawyer for the first time in his business life expecting a phone call. He gets a bill for a retainer instead, $12,000 just to have someone look at the filing. And the lawyer asks him one question that changes everything. Is the agency's cash the only thing exposed here, or is everything exposed? Marcus doesn't know. He built one entity. Client contracts, cash reserves, the intellectual property of the agency's proprietary process, even a rental property he bought last year with agency profits, all sitting inside the same LLC, all one bad ruling away from being on the table. That's the liability time bomb. At $50,000 in revenue, a lawsuit costs you a bad year. At $1 million in cash flow, a lawsuit with a single entity structure can cost you the entire business, the assets it purchased, and depending on how aggressive opposing counsel gets, a serious conversation about your personal assets too. Same lawsuit, completely different blast radius. The only thing that changed was the size of the target. This is why Level 2 exists, and Level 2 is the first real structural unlock in the entire game. It's the Holdco/Opco split, and it's simpler than it sounds. Opco is your operating company, the one signing client contracts, hiring employees, taking on the actual risk of doing business. Holdco is a separate entity above it that owns the valuable stuff, your cash reserves, your equipment, your intellectual property, maybe that rental property, sitting one legal layer removed from the daily chaos of operations. If Opco gets sued, Holdco isn't a party to that lawsuit. It's a different legal person entirely, holding assets a plaintiff's lawyer can't touch just because they won a judgment against your business. Marcus rebuilds it that summer. New LLC as the holding entity, agency operations moved into a fresh Opco underneath it, contracts reassigned, a real separate bank account for each, a business attorney who actually knows the difference between an LLC and an S-Corp election explaining why he needs both. The rebuild costs him $4,500 in legal fees. The lawsuit, once it's contained to Opco alone with minimal cash sitting inside it, settles for a fraction of what it could have taken from him 6 months earlier. $4,500 to prevent a hole that could have swallowed a $1 million business. That's not an expense. That's the cheapest insurance policy he'll ever buy. This is level 1 and 2 of the game, and if you're building anything right now, you are somewhere on this map whether you've drawn it or not. But this is only the tutorial, because once you clear $5 million, one Holdco and one Opco stop being enough too, and a whole new tier of structure comes online, multiple entities, new tax elections, a machine built to actually scale instead of just survive. That's next. Marcus doesn't feel like a two-entity structure is a small win for very long. 18 months after the rebuild, the agency crosses $5 million in annual cash flow, and the Holdco Opco split that saved him once starts creaking under weight it was never designed to carry. Because here's what nobody tells you at level 2, one Holdco and one Opco was built for a business with one risk profile. At $5 million, you don't have one risk profile anymore. You have 4 or 5, all stacked under the same roof, all one lawsuit away from taking each other down. Marcus is running the core agency, a productized SEO offshoot he spun up as its own revenue line, a commercial building he bought with agency profits to house the team, and a stake in a friend's software tool he invested in as a side bet. All 4 of those things are sitting inside the same Opco, which means the software investment that has nothing to do with client work is exposed to a client lawsuit. The building that should be a stable, boring asset is exposed to whatever risk the SEO offshoot takes on with a client who ghosts on a $40,000 invoice. One entity, 4 completely different risk categories, 0 separation. This is level 2's blind spot, and it's exactly where level 3 kicks in. The unlock at this tier is simple to say and expensive to ignore: one entity per business line, one entity per asset class. Not because it's trendy, because lawsuits don't care about your org chart, they care about your paperwork. Marcus's attorney draws it out on a whiteboard that costs him $350 an hour to sit and watch. Agency operations get their own LLC. The SEO offshoot, which has different clients, different contracts, different risk, gets its own LLC. The commercial building gets pulled into its own separate real estate holding entity, no client work touching it at all. The software investment gets parked in an investment LLC that only holds passive stakes, nothing operational. 4 subsidiaries, each one a wall around a different fire, all of them owned by the same Holdco sitting on top like an umbrella. This is the moment the game stops being about protection and starts being about strategy, because once you've got a Holdco sitting over multiple subsidiaries, you unlock tools that didn't exist at level 2. Intercompany loans, for one. Holdco can lend cash to the SEO offshoot to fund a slow quarter, structured as an actual loan with interest and terms, instead of just siphoning money across entities with no paper trail, which is the fastest way to make a judge treat all your entities as one big pile anyway. Management fees are the second tool. The Holdco can charge each Opco a management fee for oversight, admin, and shared services, which does 2 things at once. It moves cash upward legally, and depending on how it's structured, it can shift income into whichever entity makes the most tax sense that year. And then there's dividend upstreaming, profits from each subsidiary flowing up to the Holdco as dividends rather than sitting exposed at the operating level, which means when one line of business has a brutal year, the cash that already moved up is safe from whatever's happening down below. This is the actual holding company tax strategy people think starts at the billion-dollar level. It doesn't. It starts right here, at $5 to $20 million, the moment you have enough entities that moving money between them intentionally is worth more than just letting it pile up wherever it landed. But here's the trap almost everyone at this level walks straight into, and Marcus nearly does too. His new attorney gets excited, really excited, starts pitching a structure with 9 entities for a $6 million business, separate LLCs for every client vertical, a Delaware entity for tax reasons Marcus doesn't fully understand, a trust layer on top of the Holdco that adds another $8,000 in setup fees, and a K1 headache every April. This is the classic level 3-4 mistake. Over-engineering the structure before the revenue actually justifies the complexity. 9 entities means 9 tax returns, 9 sets of books, 9 annual state filing fees, 9 things that can go wrong administratively while you're supposed to be running a business. Marcus's accountant does the math out loud in a call that saves him from himself. At $6 million, 4 entities covers every real risk category he has. 9 entities is paying $15,000 a year in extra compliance costs to protect against risks that don't exist yet. The real cost of getting this wrong shows up 2 doors down from Marcus at a business owner named Renata who scaled a home services company from $4 to $17 million in 3 years and never touched her structure once. Same single Opco the whole time, holding operations, 3 commercial vehicles, a warehouse she bought outright, and cash reserves north of $900,000. A workplace injury claim against one of her crews turns into a lawsuit that names the entire company, and because everything sits in one LLC, the warehouse and the vehicles and the cash reserves are all technically on the table. She settles for $640,000 to make it go away before Discovery gets deeper into the entity's assets, money that could have been sitting safely in a separate real estate holding company the whole time for the cost of maybe $3,000 in formation fees. That's the arithmetic of this level. Understructure it, and one bad year erases what took 3 good years to build. Overstructure it, and you bleed slow money every single year protecting yourself from ghosts. Marcus lands on 4 entities under one Holdco. Clean, boring, exactly sized to the risk he actually carries. And it holds right up until the day the business crosses $20 million and an entirely different kind of problem walks through the door, one that has nothing to do with lawsuits at all, and everything to do with the fact that institutions are about to start looking at him differently. The day Marcus's agency crosses $20 million, nobody throws a party. Instead, a private equity firm out of Chicago emails asking for his data room. Marcus has never heard the phrase before. He thinks it's a joke. It is not a joke. It's the moment Level 4's 4-entity structure, the one that was perfectly sized 18 months ago, gets exposed as a toy compared to what the next tier actually demands. Because somewhere between $20 million and $200 million, you stop being a business owner that institutions ignore and become a business owner that institutions want to buy pieces of, lend money to, or audit the hell out of before they'll do either. And institutions do not deal in LLCs run out of a founder's back pocket. They deal in structure. This is the level where the holding company stops being a legal shield and starts being an actual company. Not in theory, in practice. Marcus's Holdco up until now has basically been him with a fancier letterhead. He signs everything. He approves everything. He's the board, the CEO, and the guy who still personally checks the agency's Stripe account at midnight. At $20 million plus, that stops working, and not because Marcus loses control, because the people he needs money or credibility from won't take him seriously without a real governance layer sitting on top of the money. A Holdco at this size needs an actual board, even a small one, 3 or 5 people, some independent, some not, that meets quarterly and signs off on anything above a set dollar threshold. It needs a management layer underneath that board, a CFO who isn't Marcus, a general counsel who isn't Marcus's cousin from the wedding, people whose entire job is running the holding company itself, separate from running the agency day to day. The Holdco becomes its own operation. That's the unlock at level 5. And once that layer exists, something else becomes possible that wasn't on the table at $6 million, a family office-style structure sitting beside the operating Holdco, built specifically to manage everything that isn't the core business. Because Marcus doesn't just have an agency anymore. He's got the commercial building from level 3, now worth $4.2 million after 2 refinances. He's got the software stake that turned into a real asset worth 7 figures on paper. He's got a growing pile of personal investments, an index fund account, a stake in a friend's restaurant group, cash sitting in 6 different places doing nothing in particular. A family office entity, sometimes structured as its own LLC or a private trust company depending on the state, exists purely to organize that pile, hire an investment advisor, centralize the tax planning, and stop Marcus from managing 7 different logins to keep track of money that used to fit in a single spreadsheet. This is the wealth beyond the business getting its own operating system, separate from the thing that made the money in the first place. Then comes the part that actually changes how Marcus spends his time entirely, the private equity playbook. At $6 million, Marcus was building one business and protecting it. At $20 million plus, the Holdco itself becomes an acquisition vehicle. He starts buying add-on companies, smaller agencies in adjacent niches, a video production shop, a paid media buying operation, folding each one in as its own subsidiary under the Holdco. The exact same wall-around fire logic from level 3, just applied at a completely different scale and speed. This is how holding companies actually get to $200 million. Almost nobody organically grows one business that big. They stack acquisitions under one Holdco umbrella, diversify the revenue so no single client, no single niche, no single lawsuit can take the whole structure down, and let the portfolio do what the single agency never could on its own. But acquisitions at this size drag a tax problem behind them that didn't exist before, and it's the first time Marcus has to make a real decision instead of a default one. His Holdco has been an LLC this whole time, taxed as a pass-through, meaning profit flows straight to Marcus's personal return every year, whether he touches the cash or not. That was fine at $6 million. At $40 million, with multiple subsidiaries generating profit, Marcus wants to reinvest into the next acquisition rather than pull out personally. A pass-through structure means he's paying personal income tax rates, sometimes north of 40% between federal and state, on money he never even touched. A C-Corp holding entity, taxed separately from Marcus personally, flat 21% federal rate, lets profit stay inside the Holdco and get redeployed into acquisitions without routing through his personal tax return first. Marcus's accountant runs the numbers on the last two add-on deals and finds that structuring the Holdco as a C-Corp instead of staying LLC taxed would have saved him $310,000 in the prior 12 months alone. Money that just evaporated because nobody revisited the entity choice when the business outgrew it. And that's before state considerations even enter the picture, because Marcus now has employees and subsidiaries operating across 4 states, each with its own franchise tax, its own nexus rules, its own filing requirements. The old 4-entity setup was never built to track. This is also the level where staying informal stops being a minor inefficiency and becomes an existential risk. The Chicago PE firm's due diligence request isn't polite. They want 3 years of audited financials. Marcus has never had an audit. He's had a bookkeeper and a tax return. There's a difference, and it's an expensive one to learn on a deadline. He scrambles to hire an actual accounting firm to produce GAAP-compliant statements, and the process takes 4 months and $180,000 in fees. 4 months that nearly kill the acquisition because the PE firm's window to close was 3 months wide. Marcus gets lucky. The next founder who tries this without formal books, without board minutes, without any real governance trail, doesn't get lucky. Their $85 million exit falls apart in due diligence over exactly the kind of informal, undocumented mess Marcus barely escaped, and the deal that was supposed to be a life-changing number quietly disappears. By the time Marcus's Holdco crosses $200 million, Marcus himself has become almost irrelevant to the day-to-day of any single business inside it. That's not an insult, that's the design. Somewhere between the 4th acquisition and the 9th, the founder-operator model that built this entire empire quietly retires itself, whether Marcus notices or not. This is the level where a holding company stops looking like a really successful business and starts looking like Berkshire Hathaway in miniature. Not metaphorically, structurally. Warren Buffett doesn't run See's Candies. He doesn't run Geico. He owns them through layers of holding entities, lets operators run the businesses, and spends his own time doing exactly one thing, deciding where the capital goes next. Marcus's $200 million portfolio is now built the same way, whether he planned it consciously or backed into it by accretion. Picture the actual org chart at this size. At the very top sits the parent Holdco, one entity, often a C-Corp or sometimes a holding partnership, depending on how the tax planning shook out, and its only job is owning stock or membership interest in the layer below it. It doesn't sign client contracts. It doesn't hire employees. It exists purely as the vault. Beneath that parent sit regional or sector sub-holdcos, maybe a marketing services holdings LLC housing the original agency and its 3 add-ons, a media production holdings LLC housing the video and content companies, a software holdings LLC housing that 7-figure equity stake that's now worth $40 million on its own. Each sub-holdco is its own walled garden, its own liability shield, its own set of books. And beneath each sub-holdco sit the actual operating companies, the businesses with employees, clients, payroll, the ones doing the real work every single day. 3 layers deep: parent Holdco, sub-holdco, Opco. That's not overkill at this size. That's the minimum viable structure once you're managing a portfolio instead of a business. And notice what happened to Marcus in that chart. He's not in it anywhere as an operator. He might sit on the board of the parent Holdco. He might chair an investment committee. But the person running marketing services holdings day to day is a hired president who's never met half of Marcus's original clients. The CFO overseeing consolidated financials across 9 Opcos is someone Marcus recruited from a private equity portfolio company, specifically because she'd done this exact job before at this exact scale for someone else's empire. This is the level where founder and operator become 2 completely different job titles held by 2 completely different people, and trying to keep them the same person is how empires stall out around $150 million instead of pushing through to $1 billion. The real engine at this level, though, is something most people never even hear about until they're standing inside it: the internal capital allocation function. Think of it as Marcus's own private investment bank sitting inside the parent Holdco, whose entire job is deciding which Opco gets funded this quarter and which one gets starved. The video production subsidiary throws off $8 million in free cash flow this year, but has no great reinvestment opportunities. The software subsidiary needs $12 million to fund an acquisition of its own. In a normal business, that cash just sits wherever it landed. In Marcus's structure, it moves. The parent Holdco sweeps excess cash up from the profitable subsidiaries through intercompany loans or dividends, then redeploys it downward into whichever Opco has the highest return on that capital right now. This is precisely what Berkshire does with its insurance float, and it's precisely why the exact same entity structure that felt like overkill at $20 million becomes the single biggest value driver at $500 million. The structure isn't just protecting the money anymore. It's actively making the money work harder than any single business ever could on its own. There's one more layer that shows up at this size that nobody warns you about early enough: the estate. At $1 billion in enterprise value, Marcus isn't just running a portfolio, he's staring down a generational transfer problem because the federal estate tax exemption, even at its most generous, doesn't come close to covering a 9 or 10-figure estate. This is where dynasty trusts, grantor-retained annuity trusts, GRATs, and family-limited partnerships stop being things rich people do in movies and start being the only thing standing between Marcus's kids inheriting a functioning empire versus inheriting a 40% tax bill that forces a fire sale of half the portfolio just to pay the IRS. Smart operators at this level start moving ownership interests into trust structures for their kids a decade before they think they'll need to, precisely because the value only keeps growing, and every year you wait, you're transferring a bigger, more expensive asset into that trust instead of a smaller, cheaper one. Here's the takeaway that should have been obvious back at level 1 but almost never is. The LLC that protected Marcus's first $1 million would have been legally and financially catastrophic left untouched at $1 billion. Every level in between demanded its own restructuring, and the founders who waited to fix the structure until the pain forced their hand always paid more than the ones who planned the next level early. And that's the expensive mistake hiding in almost every holding company story you'll ever hear: restructuring too late. Owners routinely discover, somewhere around month 14 after an audit, a lawsuit, or a failed acquisition, that a fix which would have cost them $15,000 2 years earlier is now costing them 7 figures in overpaid taxes or exposed personal assets. If you want the full breakdown of exactly when to make every one of these structural jumps before they cost you, grab the book linked in the description. It's the roadmap I wish existed before I learned half of this the expensive way.